Venezuela's crude and fuel exports reached approximately 921,000 barrels per day (BPD) in November 2024, representing the third highest monthly export volume of the year. This marginal 3% month-over-month increase signals operational adaptation despite simultaneous infrastructure failures and intensifying U.S. geopolitical pressure. However, performance remains 5% below November 2023 levels, indicating ongoing structural challenges to production capacity. Strategic response to infrastructure disruption. The November export performance reflects deliberate operational strategy by PDVSA in response to significant facility constraints. A major fire at an oil upgrader facility in October forced permanent shutdown of that production line, eliminating the company's capacity to generate upgraded crude grades at that location, rather than allowing this bottleneck to cascade into export reductions. PDVSA implemented a compensatory diluent importation strategy, substantially increasing naphtha imports to maintain flow rates of extra-heavy crude. This tactical response demonstrates organizational resilience but masks underlying production vulnerabilities. The heavy reliance on external diluent supplies, particularly naphtha, to sustain export volumes indicates that Venezuela's core production capability remains constrained by both infrastructure limitations and access to specialized refining inputs, geopolitical pressure, and market access. U.S. military and naval pressure intensified during this period, with strikes on alleged drug smuggling vessels in the Caribbean and stated threats to expand military operations tool and base targets within Venezuela. Despite this heightened geopolitical tension, crude shipments proceeded without major disruption, suggesting either effective operational compartmentalization or tacit acceptance of current Venezuelan export flows under the Trump administration's existing policy framework. Notably, U.S.-Venezuelan oil trade continued through Chevron's licensed operations, with American-bound exports increasing to 150,000 BPD in November from 128,000 BPD in October. This expansion occurred concurrent with elevated U.S. military presence, indicating that Washington maintains differentiated strategic interests, deterring drug trafficking and asserting military dominance while permitting controlled energy commerce through authorized channels. Market concentration and supply dependencies. Export destination data reveals significant geographic concentration. China received 80% of shipments, approximately 746,000 BPD, with Cuba receiving 24,000 BPD and the U.S. accounting for 150,000 BPD. This dependency on Chinese markets for the majority of Venezuelan crude creates vulnerability to bilateral political shifts or Chinese energy policy changes. The reliance on Chevron, a U.S. company, for American market access also represents a strategic choke point, as U.S. licensing decisions directly control Venezuela's access to premium energy markets. Import patterns further illustrate structural dependencies. Light crude and fuel imports more than doubled during this period, supported by supplies from both Chevron and Russian partners. Venezuela's need to import diluents to process its own extra-heavy crude reserves highlights the paradox of possessing vast proven reserves, the world's largest, while lacking the technical and financial infrastructure to develop them independently. Year-over-year context and trend analysis. While November exports represented the third highest monthly level of 2024, the 5% year-over-year decline versus November 2023 signals ongoing productivity challenges. OPEC data indicates that Venezuelan crude output averaged 856,000 BPD in 2024 across all production sources, 14% improvement over 2023's 749,000 BPD average, yet export volumes have not scaled proportionally, suggesting either increased domestic consumption, infrastructure bottlenecks, or inventory management policies. Outlook and risk factors. PDVSA's ability to sustain current export levels depends on three critical variables: 1. Maintaining access to diluent supplies amid evolving sanction regimes; 2. Securing financing for facility repairs and maintenance given U.S. financial system restrictions; and 3. Navigating a potentially volatile geopolitical environment. In the Western Hemisphere, the organization has demonstrated tactical adaptability in compensating for infrastructure failures through supply chain adjustments, but structural recovery remains dependent on international investment and sanctions relief, neither of which appear imminent under current U.S. policy conditions.